Let's go back to the example that we used in the previous module, the Bacall company. The business is almost ready to start trading. It has completed 2 essential actions, summarized in the opening balance sheet. Firstly, it has pulled together financial resources. €150,000 in fixed funds comprising capital plus financial liabilities, and €45,000 in short-term funds, in other words, funds repayable in the short term. The total of these sources of funds therefore amounts to €195,000. Secondly, what are the uses of these sources of funds? In other words, how have they been employed? Bacall acquired €90,000 of equipment and €45,000 of initial stock. It even has cash left over, a real textbook case. The business has also opened a shop and taken on a salesman so trading can begin. Once the company has been set up, it will pursue its economic objectives, which are related to its core business. In our example, Bacall is a clothing sales business. Its operating cycle is as follows. The company receives garments from its supplier, then sells them to its customers in its shops. This money enables it to pay its operating expenses and to potentially generate a profit. The company will focus on generating a profit as its survival depends on this. Let's go through the company's activities during its first month of trading. On the 5th of January, it sells goods for €55,000, receiving this amount immediately by cheque. On the 12th of January, it buys another batch of goods on credit for €50,000. On the 15th of January, it resells the batch for €60,000, allowing the customer to pay on credit. On the 24th of January, it pays the suppliers by cheque for the first batch bought, and on the 28th of January, it buys a third batch of goods for €50,000 with immediate payment terms. We will go through each of these transactions in the following screens. On the 24th of January, the company pays its supplier €45,000 for the first batch of goods that it bought prior to January. This payment is made from money available in the bank. The transaction results in a reduction in the bank and a reduction in trade payables for the same amount of €45,000. Are expenses and payments the same thing?
No. Each term has its own specific meaning. Let us take the example of a machine to make this clearer. The purchase of a tailoring machine by Bacall supplier involves an outflow of money. The machine manufacturer exchanges a product manufactured by his factory for money. This transaction is a payment for Bacall supplier. Use, wear and tear, and therefore the loss in value of the asset represent cost for the business that are not immediately paid out in cash terms. This loss in value gives rise to an annual depreciation expense, which represents the consumption of this fixed asset. Later, we will look at the fundamental difference between capitalized costs and consumption, which is shown as an expense in the income statement of each year in question. To summarize, purchasing a machine generates an immediate outflow of funds or cash when it is purchased, but gives rise to a non-cash expense spread over several years as it is used.
Are the sales recorded in the income statement for year N the sales invoiced in year N?